Hi, everybody. I'm Anthony Morena, principal of Mortar Group, and we're just going to take some time today to talk about some of the lessons learned over the years and how it can apply both to sponsors and investors, new and old, and just kind of walk through that a bit, and then take some questions about just real estate and kind of what we've been up to in general. Some general disclosures to start off. Before we get into the details, in case some of you are not familiar, so Mortar Group is a New York-based real estate firm. We are more of a boutique shop. We're focused on small to mid-cap multifamily in New York City, predominantly, if you're familiar, Manhattan, Brooklyn, and Queens. And we focus on sub-institutional deals where the bigger guys are not looking, essentially. And that usually works out to deals where it's about 5 to 40 units per offering, up to about $40 million per deal. And we kind of work basically where we know. I grew up in New York, and I know it like the back of my hand. And in New York, it's a very condensed space. There's buildings one on top of each other, so you really need to know the intricacies of things. So I think that really comes into to play to help. In general, the way we work is we're kind of a bit of a syndicated fund hybrid, where we'll pool together some assets, usually 2 to 3 assets in select neighborhoods, and launch those as part of a general offering that we do about once or twice a year. In general, with Mortar Group and with my background, so my background before I went into development investment management is architecture. I went to architecture school, got licensed in New York City, started practicing, and early in my career learned that I really didn't have as much control of things as I thought I did, and kind of very quickly eased into development and kind of merging real estate development, construction administration, asset management, and the architecture all into one. And that was kind of the initial kind of plan for Mortar and how we kind of came to be. And that's kind of been our model over, heading into 25 years. I started in 2001. So it's kind of been a slow growth of the company. And our model kind of tends to refine again over and over through the years. At this point, we've got about 450 investment partners that we work with. We've completed about 30 investments over the last 25 years, and about $340 million in gross sales. So now we can kind of just jump right into it. The good, bad, and the ugly, my favorite photograph, my favorite movie. It's a good way to kind of kick it off. Real estate has its good parts, it has its bad parts. It's just understanding and really getting a sense of how it works, and really that's kind of the key to kind of really jumping into it. In general, the high level points are, just don't believe everything you hear. There's a lot of, over my career, I started off very kind of friends and family. Like my first deal in 2001 was with my dad. That partnership lasted 1 deal, and for the sake of family. And then it kind of grew to friends, and then that was 10 people. Then it grew to 20, and it grew to 40, and now we're up to about 450. And now, over the last 5 years, social media and everything has kind of taken over a bit. So there's a lot of stuff online, so it's really kind of paying attention to what you see and what you read. In general, know the risks. Take your time with deals, partner with experience, define the goal, and understanding the tax implications of your investments. And starting with don't believe everything you hear, like I was saying, with everything online, there's a lot of people, saying that there's, avoid quick, I would say just try to avoid quick rich schemes and the deals that are going to make you retire tomorrow. Have some patience, do some research, look for the good and the bad in all the deals. Every deal has its high points, it all has its low points. It's just a matter of looking into it. Real estate is a business where there's no guarantees. So I would always be careful for that, because you kind of see that pop up sometimes, and it's confusing sometimes to investors. And any deal in real estate, whether it's a big deal, small deal, $100,000 or $100 million, is going to have its highs and lows. A deal always starts up at the high point, and then there's going to be some peaks and valleys throughout the process. I think a good part of working with the sponsor is understanding where we are, and then, as you work through a process, you end up on a good point at the end. That's kind of the key. And like you guys are doing here, speak with other investors, dig into forums, learn about different sponsors, learn about different deals, different marketplaces, and kind of go from there. Knowing the risks, there's a lot of different risks in real estate. There's the market risk, asset risk, financial risk, liquidity, and inflation. A lot of these have kind of come into the market over the last 5 to 6 years, starting with COVID. A lot of these things have kind of come into play. But with real estate, the general consensus is, and for what we do is, we are trying to get returns in high teens, low 20s on an annualized basis. That comes with risk. If you prefer less risk, it's in indexes where we always kind of tell people put the majority of your investments in indexes, keep it safe, it's more stable. And that's a 4 to 5%, maybe 6% return on your capital. But if you want to allocate some to real estate to try to shoot for those higher points that kind of help blend everything out, that's the way to do it. But always blending it is good. Liquidity, risk is always a big one because once you take part in an investment, whether it's a 3-year, 5-year, 10-year deal, the money's kind of parked in there unless there's a redemption option. And you won't have access until the exit. So just another thing to think about. And yeah, each, depending on what market you work in, what type of asset, is it self-storage, commercial, retail? There's so many different kind of ways you can look into real estate. So just getting a handle on kind of that. You have your core versus your value add, you're more opportunistic. Mortar in general, we tend to work on the value add and the opportunistic side, depending on what we're up to. But yeah, it's just having a good understanding of it really, I think, is the key. Oop, did I lose one? Okay. And take your time. Going back to the social media thing and a lot of the stuff you'll see on LinkedIn, Twitter, Instagram, it's the sexy deals are the ones that are usually the most dangerous, in my opinion. I'm biased, obviously, but it's the ones that are not sexy and that they're steady, and it's like what I tell my kids, the turtle is always going to win the race. You go nice and easy, and you try to deliver on each deal. That's kind of what we do. Like I was saying before, diversify, don't put all your eggs in one basket. Understanding investor accreditation. Working with Mortar and a lot of other shops, investors have to be accredited, so they have to go through a process. And I think with that, you get to do your own homework and really understand the structure of deals. And I think that's an important part. And understanding, going into what you get into. When you look at a sponsor's presentation, their offering docs, their PPMs, really kind of look at the details. How are they getting paid? Every sponsor has to take a fee somewhere to cover their staff, their office, for whatever it is, a 3 to 5, 10-year term. How is that getting done? Is it market rate? How does it work? I think a lot of times just talking to a sponsor after you have an understanding of it, speak to the sponsor or one of the representatives and just get an understanding how it works. Like I was saying, once you're in to a deal, it's illiquid, and you have to be comfortable with that. And then now getting into the partner side, getting into the sponsor, know who your sponsor is. My preference in people that we work with that are consultants, contractors, are people that, I kind of look at them the same way as I hope some people look at sponsors. It's like, what's the experience? How long has that person been around? When you look at real estate, when I started in 2001 in New York, we had September 11th, which kind of where my first project felt that. And then we jumped and kind of fell right into Lehman crisis of 08, then COVID, and now with rates. So you want a sponsor that's kind of been around, might not have to be around for 25, 30, 40 years, but someone that's seen a couple of the cycles and understand how they did. How did they do in those projects? What did they learn? How did they modify their offerings and their setups? I could tell you with every deal that we've done in a bad cycle, you learn certain things that you weren't hedging against in the past. There were certain things in COVID that we never planned on. You never planned on a pandemic, so you build certain factors in and different margins and contingencies in to try to protect against those things. With real estate in general, it's a very small world. So from a sponsor's perspective, you've got to be careful with the deals and how you do things. You want to end up doing things well and doing right by people. I think that's kind of the goal. It's experience, I think, that will take you a long way. including with sponsor experience. It's what's the presence in the sponsor's market presence, what's their track record, skin of the game, and what's their liquidity and cash reserves. With market presence, there's a lot of different shops that'll be nationwide, sometimes international. Regardless of the firm, they all should have like a local presence. For us, and for me personally, I prefer New York. I feel comfortable with it. We've explored in the past looking at different deals outside of the country, or outside of New York. When COVID first started, we started looking here in Texas, we started looking in Miami, and I never got comfortable with the idea of looking at a deal on Google Earth and then trying to build a package around that. It was never my thing. I didn't like it. Granted, I was probably wrong, because I probably would have done a lot very well in Miami or in Austin in 2020. But that's kind of something to think about. Track record is important. Know the deals that the sponsors have done, what ones have gone well, what have not, and why. If you've been around and you've been in real estate long enough, there will be deals that don't go well. And it's understanding why. And what did they learn, and how do they protect capital? There will be deals that, most of them will probably do well, but it's getting a just understanding of those kind of deals and, what happened. Skin in the game is a big one that comes up, I think, a lot with investors, and both new and old, with, just questions. What's the sponsor's skin in the game? Do they have money in the project? Their own equity, 10%, 5 to 10% of the equity commitment of the deal. With us, it's kind of I provide the personal guarantee on the debt. So the senior debt has a guarantee where if anything was to go wrong, my house is kind of on the line. So it keeps me motivated to want to do deal well and finish it as we promised. And a sponsor should always have liquidity and cash reserves set aside for when things don't go well. You hear a lot of horror stories sometimes about capital calls, dilution of shares, all these kind of things. A big way that we try to mitigate that is the sponsor basically handles any issues up to a certain point. There's only so much you could do with any deal. But if there's a short-term setback, sponsor comes in with liquidity, fills that hole, doesn't have to go to investors. Investors hear about it, but there's no kind of question about a capital call or these sorts of things. And I think that helps, and especially when markets go poorly and when rates go from where they were in 21 to 2025, a sponsor's liquidity is going to save a deal or it's going to sink it. It's, for me, it's simple as that. Another big one that I think this is almost the first at times, is defining the goal. What's the objective? When you're putting your money, a percentage of your savings, your income, what are you looking for? Are you looking for just a general set capital appreciation every year? Like, I'm going to grow my savings by X percent a year. This is my objective. Are you looking for passive income? You're looking for quarterly distributions to offset or to blend with your general W-2 or your general income? Are you looking for tax benefits? Every investor that we work with kind of has their own strategy, and it's when you speak to different people, it's kind of interesting to get a blend and kind of get a sense of, how many different paths you can take really to find what works for you. Whether someone has a large W-2 offset or a large gain, they sold something, they need a depreciating asset to kind of help offset it. So there's a lot of different ways you can go. Big one is also just diversification, like I was saying. If you've got a lot of your investments in more stable assets, stocks, bonds, mutual funds, indexes, and you want to diversify a portion of it into real estate, that's always a good way to do it. And it's an inflation hedge, which you've seen kind of over the last few years. So there's a lot of different ways you can go about it. In understanding the tax implications, and getting into a more detailed portion of this, there's a lot of different ways you can go as well. There's, the depreciating asset, like each real estate deal has a depreciation, so you'll get a loss on your K1s that usually are distributed annually for investors. So if you're looking for that as part of your objective and your goal with an investment, that's a big part. Over the last few years, and it's been even a big topic here, investing with your IRA, in a self-directed IRA, or 1031 exchanges, which is more for select investors that are selling an asset and are looking to offset that gain or defer that gain. Or, there's also bonus depreciation and cost segregation plans, which bonus depreciation was a bigger thing a few years ago with the new tax plan that went into effect. I think it was 19, but that's starting to phase out. Whether that gets renewed or not in the next couple of years remains to be seen. And this one, this is an older article that, I'm kind of focused on what I'm doing at times, and sometimes I miss certain things in the news. And it was about Peter Thiel and about, essentially, before he started PayPal, he took his investments, $2,000, but used a Roth IRA. He used the Roth IRA as his investment vehicle for PayPal. So essentially, when he sold the deal, or he cashed out of PayPal at the end, that $2,000 in his IRA, in his Roth IRA, became, who knows what the number is, $2 to $5 billion. And I thought, if one of the bigger investors and VCs in the country or in the world is doing this kind of thing, it's something I should take seriously and investors should take seriously. And the more I kind of dug into it, I did my ChatGPT searches on it to try to really figure out how he maximized it and what loopholes he did or how complicated was his structure. And it wasn't. It was literally a self-directed IRA. He took his Roth money, put it into a self-directed IRA, and he's an older gentleman, so when he sold, it went back to his IRA, and it's tax-free on the entire gain. So just in general, and I know you guys have probably seen this a few times, like I was saying this weekend, self-directed IRA is when you can take a portion of your Roth and invest in alternative investments, whether it's crypto, real estate, whether in a syndication or you're buying an asset, any sort of alternative investment can be invested with a self-directed IRA. So essentially, if you were to take a portion of your Roth IRA, you can find a third-party administrator, which will usually charge a few $100s to be the administrator for the deal. And your money, let's say you take $10 from your self-directed IRA, or from your Roth, you put it into the self-directed IRA, you put it into a real estate deal. That money has to flow through the third-party administrator. So at the end of the offering, what happens is you get back your $10, your initial investment, plus any profit, and it goes back through the third-party administrator and back into your Roth. So if you had $10 that you invested and you got 30 that went back into the Roth, it's all tax-free, which I think is a beautiful thing. And it's funny, over the years, we first started to see these come up with some investors, maybe it was like 2019, 2018, and it's been progressively getting larger and larger and larger. I think this year has kind of been the best year by far as far as different investors trying to work and invest in deals this way. There's a lot of, with the popularity of self-directed IRAs, there's a lot of different third-party administrators that have come to the market. There's been a few here that I've seen, but I think in general, there's about 5 or 6 shops that are larger on a more national basis that can help. And they tend to do a good job from everything we've seen. We tend to ask investors, what they thought of the process, and for the most part, it's pretty seamless with any deal that we've done with some of these guys. So as we just start to close out, I just wanted to get into some recent work about Mortar and kind of talk about the track record stuff that we do and all that. So just with Mortar, like I was saying, we're New York based, and we do a mix of opportunistic, ground-up construction, mostly in Brooklyn, some in Manhattan. But for us, for dollar, Brooklyn is kind of the most, where we can generate the most value. Our job essentially is to find a site, find a deal, and where can we extract the most dollars and the most value for investors and for the group in the shortest amount of time. And that's our objective. So we do it with a mix of ground-up construction and your more traditional value add. But our value add is more kind of taking an existing asset, doing extensions, gut rehabs, just maximizing deals to have an exit for investors. Track record, like I was saying, is important. You can go through it, and we have documentation we can share with everyone. But it's one of those things, you want to look at every deal. It's like, you want to understand, like I was saying, with 2008, with COVID, how did deals do, and how did they go? And I think any sponsor you speak with should be able to give it to you and be able to ask, answer questions that pop up about it, and go through deal by deal. I can go through every single deal we've done in 25 years, and I can give you the great ones, I can give you the horror stories, and I can tell you, why things went well and why they didn't, and you kind of go there. And I think that's just an important thing to have, is just with any sponsor you work with, is just have that conversation. Just wanted to add a couple of case studies for similar work that we do. This is more of our traditional value add stuff where we'll take a portfolio of assets. In this case, this was part of an offering that we did a couple years ago, but we'll take 3 buildings, buy them vacant, and over the course of about 24 to 30 months, we gut rehab, release, stabilize it, or sell the asset. That's kind of what we do in a nutshell. So this is 203 Richardson in Brooklyn. This is in Williamsburg, which is a very popular neighborhood. The rent numbers, when you look at parts of Brooklyn, especially when you compare it to parts of the U.S., are really mind-boggling, but the numbers are actual. The inventory in Brooklyn and in our markets in New York, because New York in general has its pluses and minuses. It gets a lot of bad press, but at the same time, there's 8 million people in New York, and when apartment shows come up, they go quickly. And that's why we try to work in certain markets. We work in areas that are stabilized. Williamsburg, Manhattan, certain parts of Queens, they're established neighborhoods. So one thing I learned from 2008 is when the crap hits the fan, the first places that go are gentrifying areas. Those markets plummet. You can't sell the asset. You can't exit. You have to be in stable markets. So that's where we try to stay. You'll pay a little bit more for the asset, but you're also getting more on the exit because it's easier to sell, because more investors that are more long-term or family offices or institutional want to be in these neighborhoods. In New York, Carlyle Group is a multi-billion-dollar shop, but they started this plan over the last 4 or 5 years where they were buying up 3 to 6 family apartment buildings throughout New York City, and specifically Brooklyn, because they felt that the value was there. And as a result, they've got an objective where they'll sell them off in 5 to 10 years and kill it. But it just points to the value of the market. This is another one, 95 Diamond, very similar to Richardson. It was part of kind of a similar portfolio where you take these assets, build up to the back of the building, stabilize the asset, and move on to the next one. And that's kind of the goal for here. With any deal that we do, my background being architecture, I'm biased a little bit, and I kind of do things a little bit different than your traditional, I would say institutional or corporate investment shop, because I care about things and I kind of lay things out a little bit different. One, because I learned development through the eyes of an architect. The aesthetics is important to me. How residents feel, how investors feel is kind of important. And that's why I kind of like doing what we do. We work in a very kind of special and localized way, but we deal with individual investors. We deal with syndications. We don't deal much with family offices or institutional capital. It's people that you kind of get to know over the years, like people that we've worked with, from 2005, 2006, that are kind of still with us, or people you meet this year or 5 years ago. There's always kind of a rapport. You get a sense of what people are looking for, and you kind of build it out that way. The last few days we've met a couple of the investors that we never met in person for a couple of these deals. Like Urban Landing was one that we launched last year, which is a 36-month offering, which is doing well right now. This is kind of a portfolio deal, and it's kind of in construction. The first project, we did a gut rehab. We finished it in 6 months. It's fully leased up. The debt was kind of permed out, and now we have the second project that'll be, I would say, completed probably by the end of the year, and then that'll go to market, and then we'll close. So usually, in general, the deals that we do are about, I would say, 30 months is kind of our sweet spot. In general, with investors that we've spoken with, that's kind of the area they like to be in, where they can be in a deal, exit quickly in 3 years, because 5, 10 years is a long time. You never know really where you're going to be personally, where the market's going to be, what you're going to want to do in 5 to 10 years. So we try to keep them short, and I think this is the way we've really found to maximize it. Another one was 316 Prospect. This was a ground-up construction project. That's the building in the top left. That's in Prospect Heights in a historic neighborhood in Brooklyn. That one did really well. The first group, which was an equity position, already cashed out. And now the last group will kind of close out probably, I would say, by May, June, and then that will close out that deal. And then the last deal that we're just kind of launching now is Hudson MG, which is another similar type of deal in Brooklyn, where we're kind of putting together this portfolio of assets with a similar kind of setup. 30 months from when we close on the asset, investors commit their capital to the exit. That's kind of the goal. We tend to work with the same teams that we've had over the years, so it allows us to, be quick and be efficient. Yeah, that's kind of just a quick roundup on us. Hope this was helpful. If you want any more information about us, you can reach out to Francesca or Hamid, who are both here. And yeah, any questions, or if you want a copy of the presentation, just give us your info. I can email it over. We can email it over. Any questions?
How many opportunities do you assess per year as you develop, take on for development?
Sure. So we tend to have about, I would say, 5 to 6 offerings running concurrently. We'll probably launch 1 to 2 a year. So basically, it's this kind of constant rotation on a 3-year schedule. We've had some deals, usually ground-up construction deals will take a little bit longer. But I think with market shifts the way they have so much in the last couple of years, the value-add deals that we kind of specialize in has been the best route, I think, for the New York market as well. And kind of being below the radar, I think has, as far as from institutional or family offices, has worked well. But yeah, I would say 1 to 2 a year we launch, and about 5 to 6 running concurrently. Yep. Anybody else? Yes, sir.
I wondered how you were going to do that. Talk a little bit about what's your minimum and what's your sweet spot. You talked about the sweet spot of 30 months for construction, but what's your sweet spot for wanting funds?
For the term of the deal?
Yes.
So minimum investment that we usually do is about $25,000 per investor. Yeah, and the deals are usually 30 months. The way we kind of break out a deal, the first thing we do is ask investors for, we usually have some time and flexibility on funding. It's usually just, with any deal that we do, we have our mailing list, we send it out to investors. It's really kind of pass the hat around, see who's interested, who wants to partake in this deal. Once you get your commitments and you know who's involved, then you have a little bit more time, so funding comes a little bit later, which kind of times with the closing of the asset. So because we do the architecture and the design in-house, before we close on a deal, or once we have a deal in contract, essentially, I'll fire up the architecture team, I'll start working on the design, so that by the point we close on the acquisition of an asset, we start construction. Like, my goal on every deal is day one of the interest, the bank interest is rolling, I want to have a bulldozer running right through the front of the building. That's kind of the goal, but just because you minimize your interest cost. That's kind of the goal, and you've got that first 6 months is kind of prep, and it's about, I would say, 2 years, or I would say usually around 18 months to get a project finished. Then the last 6 months is the exit, sales, marketing process, final K1s. K1s are always a big thing. Today is March 1st, so it's like we got some out last week, and we've got to get the rest out by next Friday. So it's always kind of a big scramble. Investors are always very concerned about K1s, but that's the last piece when we close out a deal. But there'll be returns annually, or K1s annually. But yeah, that's we try to be efficient. With any deal that we do. Let's say we're in contract for 3 to 4 months, we cover the cost, or it's my cost. If a deal doesn't close and we did all the design work, all the drawings, all the permitting, that's my cost. It's not an investor cost. If a deal doesn't close, we move on. Investors can move on. But I think it's one of those things that really kind of speeds up a deal, and it's a bit of unique setup that you don't see really with other shops, just because they can't. They don't have a technical background. They're more financial based. For us, the technical side is the easy side. So. I knew the technical side coming out of college and working in architecture. The development stuff was kind of the pieces that we had to put together over the years. Yes?
I have 2 questions. One, are we in a housing bubble like 2008? And 2, thank you. Are we in a housing bubble like 2008? And number 2, I've lived in Brooklyn, but it's been a while.
Yeah.
So are some brownstones being torn down, or where exactly are you building?
So, good question. With the issue with the bubble, or the question about a bubble in New York, in my opinion, the answer is no. In New York City is a very bureaucratic and political place, and the politics of the last 4 years really kind of frozen real estate. Plus, with the increase of rates, for construction loans in 2021, they were 4%. Now they're like 9%. So the cost is significant. So, I don't think we're in bubble because inventory has stayed low. And what we've seen now is that as the mortgage rates get close to 6%, the market is on the verge of kind of picking up. And I would say if or when rates get into the 5s, the market will pick up, sales velocity will increase, and prices will rise again in New York. Now, different parts of the US are kind of saturated, I think just as a result from COVID, but that'll kind of blend in over time. But for New York, as far as a bubble, I don't think so. Certain parts of the suburban market are, but not really much in New York City. And to the other half, there are some parts of New York or Brooklyn and even New York City which are historical districts. If there's historical brownstones, you cannot touch those. Those are sacred to us. Like Prospect Heights is where we did one deal, and there's very few vacant lots that pop up there. So we were unfortunate enough to find one, but you've got very limited inventory because a lot of it is historical. Northern Brooklyn, like where Greenpoint, Williamsburg, is less of a historical. It's more kind of older wood frame homes, just because it was a lower income market, I'd say 100 years ago, when all these homes were built, these row houses were built. So they don't have a historical basis. A lot of them are in rough shape. So usually when we're buying those assets, you're rebuilding it from scratch. So it really depends. Park Slope is a more protected area. Each neighborhood has its own metrics and dynamics. You cross one road, you go 4 blocks in the wrong direction, prices change dramatically. But that's why I think knowing where you're working and where you're investing is huge. So, yeah. Yeah.
Three questions.
Yeah.
I've heard about rent controls in New York City. How does that work? Are your properties at risk for being affected by that?
Mm-hmm.
Number one. Second, I've heard about programs for tax abatement
Yeah.
in New York City. If you could elaborate a little bit on that and how much that is.
Sure.
The third one is, what is the risk for your exit from the level of interest rates going forward?
Yeah. Sure. No, it's a good question. So the first part with rent stabilization has always been a part of New York. I think it went into effect in 72 or 73. So it's always been a part of New York City. In 2019, they enacted a new law that kind of made it stricter to destabilize units. And then they really tightened that up even further in January of this past year in 2024. So rent stabilization is one of those things that's really hard to navigate right now. There's only 1 or 2 ways to destabilize a building and have it market rate. With the work that we do at this point with Hudson and some of the new deals that we're doing is we're buying vacant assets and we're building market rate. The problem with rent stabilization, if you buy a rent stabilized asset that is occupied, it must remain stabilized. But if you buy something that's vacant, there's a path to destabilize it. So there's a lot of ins and outs of it. I'm out of time, but I'm happy to answer the question direct. But no, thank you everyone. I hope this was helpful. If you have any questions, just let me know. Thank you.